Hello, and welcome back to the channel. Have you ever wondered why some traders seem to predict market moves before they even happen? Today, we're diving deep into the secrets behind liquidity, the invisible force that moves the markets. Whether you're just starting out or you're looking for that extra edge in your trading strategy, mastering liquidity might just be the game changer you've been missing. Imagine placing a trade, setting your stop loss with confidence, and then suddenly, the market reverses exactly where you thought it wouldn't. This isn't just bad luck, it's liquidity in action. In this video, we're going to break down exactly how liquidity works, why it's your secret weapon in spotting high-probability trades, and how to avoid the pitfalls that often trap beginners. Before we dive into the details, I want to encourage you to smash that like button, subscribe, and drop a comment below. Your engagement not only helps you stay ahead in the trading game, but also supports this channel in bringing more valuable insights to you. So let's get started. Picture this. You execute a trade with a solid plan, only to see the market reverse and stop you out at your predetermined point. Sound familiar? That's liquidity at work. Today, I'm breaking down liquidity into 5 straightforward yet powerful concepts that you can apply directly to your trading. We'll cover support and resistance, trendline breaks, failed breakouts, failed closes, and a cunning tactic that big institutions use called inducement. By the end of this video, you'll start seeing charts and market movements in a completely new light. Let's dive right in. Let's begin with a cornerstone of technical analysis, support and resistance. Think of these levels as magnets, attracting price action over and over again. When large institutions make their moves, they often execute significant trades at key support or resistance levels. These moves leave what I like to call footprints on the chart. For example, picture a scenario where price bounces off a resistance level. This is typically the level where big players were offloading their positions, and retail traders might have piled in shortly after. However, the trap is set. Retail stop losses tend to be clustered just beyond these levels. When the market returns, it's like a vacuum pulling the price straight into those stops. The important takeaway here is that old highs and lows often become future targets. Every time you see the price hover around those familiar levels, remember that liquidity is setting the stage for the next big move. Next, let's talk about trend lines. As many traders know, drawing trend lines has become almost second nature. But while retail traders lean on trend lines for guidance, institutions use them in a more devious way. When the price approaches a trend line, there is frequently a hidden pool of liquidity lurking just below it. Why? Because that's typically where impatient traders have set their stop losses. Imagine watching the price approach a well-drawn trend line, only to see it get rejected, bouncing off just before it can cross over. That sudden snapback is no coincidence. It's the market's way of hunting down those stops. Trend lines, therefore, are not just indicators for potential entries, but are also traps waiting to be exploited if you're not careful. When the price reacts near a trend line, take a moment to pause and reassess your strategy rather than diving in head first. Now, let's take a closer look at something that might seem counterintuitive at first, the failed breakout. Have you ever seen the price seem to break through a key level, only to be dramatically pushed back? That's a failed breakout in action. Here's how it plays out. The market tests a critical level, and just as traders expect a breakout, it gets rejected. This rejection isn't random. It's purposely engineered to trigger a cascade of stop losses. When the stops are triggered, the market experiences a rush of liquidity as these orders are executed. Then, when the price returns to that same level later, all those orders have already been absorbed, allowing the market to move decisively in one direction. In this scenario, that level on the chart transforms into a powerful magnet. It's a signal to follow the momentum, as the real move is about to begin. Always stay alert for these failed breakout signals in your charts. Let's move on to another important concept, the failed close. A fail to close occurs when the price temporarily wicks through a level but fails to sustain that movement and close beyond it. That what you see on the candle? It's a trap laid for traders who jumped in too early, hoping for a breakout. Instead, the market uses that wick to trigger stop losses before quickly reversing course. Pay close attention to how price action develops. For instance, if you spot a candle with a long wick extending below a key support level but closing back within the established range, that's a classic failed to close setup. The best practice here is to wait for confirmation, a proper close beyond that level, before committing your trade. Patience in these moments is key. Watching for the close rather than chasing the wick can save you from getting caught in a premature move. Now, we arrive at one of the most cunning tactics used by institutions: inducement. This is the scenario where the price hovers near your target level, teasing you with the promise of a breakout, but never quite getting there. It's designed to make you second-guess your strategy and potentially jump in too early. Think of it this way. As price inches closer to a key level, many traders lose their nerve and decide to enter the market prematurely, hoping not to miss out. But institutions know this all too well. They intentionally create these scenarios to induce you to trade too soon, only to then wait for a 50% retracement. If the price reverses at that point, it often signals a fake out. The real, sustained move will come later, after these early orders are cleared out. The essential lesson here is one of patience. Trust in your original trading plan and wait for that confirmation before jumping in. By understanding inducement, you're better equipped to avoid the bait and stay in control of your trade decisions. To wrap up, liquidity isn't just an abstract concept. It's the detailed roadmap that shows you where the price is likely to move next. By understanding and identifying these key concepts, support and resistance, trendline liquidity, failed breakouts, failed closes, and inducement, you can start reading charts like a pro. You'll be able to spot those institutional traps before they have a chance to snap shut your stop losses, turning potential losses into profitable lessons. If this deep dive into liquidity resonated with you, please hit that like button, subscribe for more in-depth trading insights, and share your experiences with liquidity in the comments below. Have you ever been stopped out by liquidity patterns before? How did you manage that situation? I'd love to hear your story. Thank you for watching and taking the time to elevate your trading skills with me today. Stay tuned, stay patient, and I'll see you in the next video.